we're basically flat over the last year, almost exactly from last Father's Day to today. And people think, no, that's not right. I'm like, well, it is, but people don't think in long terms. And so I will argue that crypto winter ended June 15th last year. Crypto spring will end, June 15th this week. And then we'll be in crypto summer, probably through June of next year. And then, we go into fall, and crypto fall is where the parabolic move happens. Why does the parabolic move happen? Well, again, this is the genius of the halving. The halving creates price movement because the price has to adjust to reward the miners, and price movement attracts interest. And see, here's the thing. When the price of anything gets below its fair value, like I can make an argument based on a Metcalfe's law model that the fair value of Bitcoin today is in the high 20s, low 30s. So we're marginally undervalued. When an asset is undervalued, investors buy it, right? That's what investors do. They buy assets that are under their fair value or intrinsic value. And then as the price starts to rise, that movement, attracts speculators. And speculators aren't evil people, right? Many of them are just the opposite side of a hedger, right? The miners have to sell, and sometimes in the futures market, their future production. So a speculator, someone takes the other side of that transaction. But they don't have any real view on the asset. They just see movement and they want to buy it. But then what happens is when we get into the late stages of summer into fall, the price starts to move more quickly. And that's where people lose their mind.
Mark Yusko believes that investors have a 10 to 12 month window to accumulate as much Bitcoin and crypto as possible before he believes it goes exponential in what he calls crypto autumn. For those who don't know Mark, he's a renowned American investor and hedge fund manager who brings a refreshing perspective to the world of crypto analysis. Moving away from conventional terms such as bear and bull market cycles, Yusko applies the concept of seasonality to the crypto market. In his view, each crypto season lasts roughly 12 to 13 months, and we just entered the crypto summer at the end of June. He believes this is a period which will be fairly flat and slowly moving upwards up until the Bitcoin halving next year, in which we will enter crypto autumn, which is where we see prices move exponentially. Because the Bitcoin halving is poised to happen in 11 months from now, this would give investors roughly the next year to stack as much crypto as possible before we see all the retail influx of capital. Make sure to stick around to the end of the video where Yusko also breaks down the biggest reason why he has so much conviction in Bitcoin and crypto. That being the huge amount of capital that is going to flow from baby boomers to millennials and Gen Z over the next decade, which all will undoubtedly find a home in digital assets. Before we plunge into Yusko's fascinating insights, remember that only a small percentage of my viewers are actually subscribed. If you find value in financial content, consider subscribing or liking the video. It's absolutely free and you're always free to change your mind.
I think we're at this funky place where the price will start to move and the speculators will come. But then what happens is the gamblers come. And that's what wrecks it and causes the cycles. Because it pushes the value above fair value, and then you have to have a crash. And so if you look at the history, the cycle is, we get to fair value, then we go way above, and then we crash. And then we come back to fair value, go way above, and we crash. And so if you look at the history of halvings, it's been roughly a 10x each time we add a zero. So we went to 100 to 1,000, 1,000 to 10,000. This one will be 10,000 to 100,000. And then the next halving will be, 100,000 to 1 million. And you think, well, why is that? Well, it has to do with how many wallets and how many people and how many transactions. And one of the interesting things about that point you made is, look, it has been the best performing asset 11 of the 14 years. Now, I kind of truncate the first 4 years and only look at the last 10, because the first 4, we're talking about fractions of a penny to $1 to $2. We was in a science experiment. There just wasn't any volume. You couldn't put any real money in it. You could put $50 in it, but if you were willing to,
you have to figure out how.
if you were willing to risk the $5 wrench risk, right? Meet the guy in the back alley with the thumb drive, and he hits you in the head and takes your Bitcoin and your money. And, stuff like that happened. But now we're at a point where, at 400 plus billion, we could, I think I have that value, right? Let's double check. But at 400 plus billion, we're talking about, 500 billion. So at $500 billion, you're talking about an asset that real money can come into. Like real institutions, like big pension funds, big endowments, big foundations, individuals, as I like to call them, individual institutionalized capital. They can buy this asset. So now it's real. And the best part about it is, over the last decade, had you just taken 1%, just 1% from stocks and bonds of 60-40 portfolio, 0.5% from each, and put 1%, you would have outperformed by about 250 basis points per year. And if you added 2%, it was closer to 500. And at 3%, it was closer to 700. And so you didn't have to put a lot to get a lot. And people say, oh, but it's so volatile. Like, you mean more volatile than Amazon? Do you own Amazon stock? Well, of course I do. It's in my index fund. Amazon stock and Bitcoin have the exact same volatility, 80. Exactly the same. Amazon's longer, 27 years. Bitcoin's 14 years. What's crazy about it is the return of Amazon over that 27 years is 40. Now 1.4 to the 27th power is a big number, big. But Bitcoin is closer to 90. So 1.9 to the 14th power, bigger number. But you probably won't have that return. Back to your question, it won't have that 90% return going forward, just law of large numbers. Mm-hmm. And we'll compound it at a lower rate, but we'll trend down to that 40% compounded probably, because that's a nice compound return for an innovation asset class, and Amazon is one of those. But Amazon, every single year, including this year, has had a double-digit drawdown, 5 times more than, and the average is 31%, 5 times more than 50, twice more than 90. But when was the right time to sell? Never. But who bought it 27 years ago and held it to today? There's only 5 people in the whole world: Jeff, mom, dad, ex-wife, and Bill Miller, whose cost is 7 cents. And so everyone else was afraid of volatility. And that's why people don't like Bitcoin, because it's so volatile. But you want volatile assets in your portfolio, right? The worst asset you could ever own is cash, long-term. Short-term, it can be a good thing. And some right now might not be a bad thing. But over long-term, you're going to get chewed up by inflation and you're going to lose money. So you add bonds, which are riskier than cash, and your return goes up and your risk goes down. How can that be? Well, Markowitz won the Nobel Prize for this. If you had stocks, risk goes down. If you had hedge funds, risk goes down. But all those assets are volatile. Yeah, but they're uncorrelated to each other. And the beautiful thing about Bitcoin is it's perfectly uncorrelated to all the other assets. It's 0.0 correlated to bonds and 0.15 correlated to stocks. People say, oh, but Mark, last year it was highly correlated. Short-term correlations don't mean anything. In crises, particularly liquidation crises, all correlations go to 1 in all assets: stocks, bonds, currencies, hedge funds, commodities. It doesn't really matter. What matters is what's the long-term volatility. And the long-term volatility of Bitcoin is low relative to financial assets because financial assets derive their value from the same thing: GDP growth, inflation, interest rates, corporate profits. None of those things have anything to do with Bitcoin. Bitcoin is driven by millennial adoption. Here's a crazy thing. You ask any person over 35 in my cohort, who's your broker? UBS, Merrill Lynch. Why? How much gold do you have? I don't know, 3-4%. How much Bitcoin do you have? Wow, God, 0. The Ponzi scheme. Haven't you heard that Peter Schiff guy? Often use DeFi. What's DeFi? Yeah. Ask anyone under 35. Who's your broker? What's a broker? You mean my Robinhood account? I got a Robinhood account. How much gold do you have? Oh, 0. Boomer rocks? Haven't you heard that Peter Schiff guy? Yuck. Okay, how much Bitcoin do you have? Don't want to talk about it. Why not? Big part of my net worth. I'm kind of embarrassed. So that digital divide is real. And here's the thing that gets me probably the most excited. There's $37 trillion that my generation owns. The boomers and the silent generation. Okay, 37 trillion with a T. That's $37 every second for 31,710 years. It's a lot of money, right? A lot of money. All that money is going to y'all. It's going to the echo boomers. All of it. We're all going to pass away, hopefully not for anytime soon, but we're all going to pass away. And it's all going to get bequeathed to the next generation. And that generation is not going to put it in stocks and bonds. It's going to put it. And here's the cool thing. I have a 6-month-old granddaughter, and my 6-month-old granddaughter will never have one of these. She will never have a leather wallet.
Oh, yeah,
She will never use paper money, ever. She'll never touch it. She will only have digital. She will never think in fiat terms. She'll think in digital terms. That's amazing. That's really cool. And humans are fallible. And this is a better system. So the idea that this form of money isn't going to replace this fallible system. I mean, this morning, JP Morgan agreed to pay a $290 million fine.
I know.
Again, here's the crazy thing. The fines paid by banks for money laundering, bribery, corruption, spoofing, roughly equal the market cap of Bitcoin.
Mm-hmm.
And that's just the fines for the things they got caught and agreed to pay. How about all the stuff that didn't get caught? Orders of magnitude bigger, trillions of dollars of badness that's gone on in this system that can be corrupted. But decentralization fixes that.
So there's Mark Yusko on why he believes investors only have a 12-month window to accumulate as much crypto as possible, along with his intriguing take on the opportunity that lies ahead in the crypto autumn. The application of the concept of seasonality to cryptocurrency and the anticipation of exponential growth following the Bitcoin halving certainly gives us a lot to think about. One of the striking insights Yusko offered is the potential impact of the generational wealth transfer from baby boomers to millennials and Gen Z. With a monumental amount of capital shifting hands, there's an undeniable likelihood of a significant portion finding its home in digital assets, given the younger generation's affinity for technology and innovation. As investors, it's imperative to gauge the market dynamics and trends meticulously. Yusko's insights emphasize the importance of staying vigilant and capitalizing on time-sensitive opportunities. Is your portfolio prepared for the potential surge? How can you optimize your investment strategies in line with Yusko's predictions? Remember, investing always carries risks, and it's crucial to make well-informed decisions. Take the time to do your own research and consider diversification to mitigate risks. As we wrap up, if you found this video insightful and it has helped shape your investment thoughts, please share with others who might benefit. The knowledge shared by experts like Mark Yusko is invaluable in navigating the often turbulent waters of the investment world. Anyway guys, hope you all enjoyed today's video and that provided you with some value. I'll see you all in the next one, and as always, all the best.